how to determine those things. We just want to introduce the documents and the bigger overview terms before we do that in the next 2 lectures. Financial quarters. So when do they open and close? These are for this year, and you can do a lot of, I want to say, analysis, but these dates are really important because they announce earnings, and you figure out you can once the quarter closes, they're required to stop taking new information onto their statements. And within about 3 weeks or so, they've released their quarterly statements. So depending on when the release is, the stock price will either jump or fall or stay the same. But it's more information for you as an investor to judge and invest off of and make informed decisions. So like an example, there's this great restaurant, Chase knows. Actually, Chase and I went there for his birthday in January, BJ's Restaurants. And I did some financial statement analysis with a buddy of mine. We were kind of bored, and on a Friday night, as NYU Shanghai quarantine kids are, and we kind of just said, wait a minute, we want to analyze their earnings for the third quarter. What's going to happen to them? Because after the first quarter, they announced their earnings, and it was terrible because all of the restaurants had closed down because of COVID. So we went ahead and read the reports, read how much debt they were in, understood their liabilities, and then drawing in outside information to create an investment prospectus. We went ahead and found all the data for all the states that are closing restaurants, and then compared that to BJ's portfolio of assets in what stores are open, compared the two, and then ultimately decided their quarter 3 earnings are going to be terrible, and we're going to invest right after quarter 3, because I don't personally love margins, and derivatives I could have, but that wasn't what I was thinking at that moment. But we called it, we wrote it down, and we said quarter 3 earnings are going to come, they're going to drop, and then it's going to rise after that because the market will be recovering. But like, that's what financial statement analysis is. It's seeing how much debt and how healthy a company is. It's as simple as reading it and saying, wow, this is great, they're going to do well, they have a lot of cash, or as complicated as using the ratios we're going to go over. But yeah, so we're going to talk about speculation versus investment. And just for some user engagement, does anyone have any guesses to what the difference is between speculation and engagement is? Speculation and investment is? I know some people have their cameras on. Just jump in.
Yeah, so I think speculation is more like maybe taking more of a risk. You know, I've heard my friends talking about this company, I want to get in on it too. Maybe like fear of missing out goes into speculation. But investment involves more of like financial statement analysis and such.
Yeah, that's perfect. Why is it not going to the next one? Did we do it? We have so many transitions, so fancy. Yeah, speculation is the act of putting money into a financial endeavor with a high probability of failure. Some compare it to gambling, and it's much more based on your emotions and what you're feeling. And if you want to take a risk on something and say, wow, I'm betting on Elon Musk and Tesla, even though they have they have no assets. Like that was something someone did 5 years ago and said, wow, I'm going to speculate on Tesla. I'm going to speculate on Nikola. I'm going to speculate and buy this stock. That's different than investing. And I think it's a very important thing that we all talk about and understand, that there is a difference. And I'm not saying one is wrong, one's right, but I think it's important that we have that in our heads to think of what are we speculating for. So like, I'm not proud of this, but after Luckin Coffee bottomed out, I was speculating that they would go up, because I know that a small cap stock, if it increases $1, is a 50% increase, whereas something at $20 increases $1, it's 5%. So I was at the bottom of Luckin, I was speculating on the drop and the bounce. So that's a different thing, because if I was investing, that is not something an investor would do. And I think Jared and I both kind of played the up and down on that one. It was pretty fun. It's gambling, and like, I love gambling. I'm not against it. I just want to make sure everyone knows that speculation, investment, different ideas. And there are people out in the world of investing who have really, it's a part of your portfolio. It's not it's not like you can't shun it. It's there. So in terms of speculation, I think Scott said it really well. It circles around hot market buzz, top picks, and it's things that shoot up for what, and when you read their financial statements for no good reason. Like, it has to do a lot with outside influences off the market dictating prices and making people think there's a bubble or think, wow, this is going to go up. I think a good example of that was, I think there was an article in the Wall Street Journal about American Airlines is going to come back online in like 3 weeks. It shot up 30% that day. 15 over like 3 days, it shot up like 30%. And that was speculation. There was no reason to believe that that was going to happen. And it was just the investors wanting to do it, which is another real demographic that we're going to talk about. But back to my point about speculation is a real thing that is taken seriously. Is in Benjamin Graham's Intelligent Investor, he says that about 10% of your portfolio can be allocated to speculation on stocks, and that's like a real thing. And that's the holy grail of investing right there. That'll be the first thing I recommend for any of you guys for extra reading too. But yeah, I know that for a while I've been tracking specs. We'll get into that in lecture 7. But Virgin Galactic, that was my 10% of my portfolio that I was speculating with. It's a real thing, and not to be looked down on, but just understand responsibly that it should be about 10% of your portfolio. So then now we go into what investing is. The result of a methodical investment prospectus based on market research. Jin said it the best at the beginning. So if we read through these statements, we decide this is a good opportunity for either a buy, sell, or short, we do it and we execute and we say, we've done our research. We believe this is going to happen based on X, Y, and Z. It's undervalued, overvalued, whatever. And you can invest in both directions. In the instruments we'll learn about later. Chase, you're going to hop in here.
All right. So first we'll get into the opportunity cost of investing. So like, what is an opportunity cost? Most of you guys have probably heard that term before, especially if you've taken an economics course. Opportunity cost is the loss of potential gain from other alternatives when one alternative is chosen. So when it's in terms of an investor, it's more of a foregone opportunity. So it could have been, it could have been if you chose a stock or an investment decision that had a higher yield than a lower yield risk-wise, but it ended up giving a higher one when you chose a lower. That's the opportunity cost there. Go to the next slide. So what is the opportunity cost? Like, what is your cost as an investor? Is the time you spend researching, the energy with researching, the people you reach out to, things like that. Those could all be used to be doing something else. Like you could have worked on a project or something rather than taking that time to research a stock that might have not given you what you wanted. Yeah. You want to add anything?
Yeah, I think that sums it up really well. Any volunteers to give an example of opportunity cost that you guys have had? And if you understand the term, great. I'd love it if you guys kind of chipped in, helped the rest of the members get an idea. So let's think about it really broad, really simply, like how Chase put it, the trade-off of one for the other. So if you think about the people in the stock market that you're investing with and against, you break it down to every stock is bought and sold. There's a singular transaction on each of the orders that you're putting out, and in that way the order's filled. So if you think about the opportunity cost that you have as a person reading your 10-15 minutes a day and saying, I think that this opportunity is great and I'm going to invest my money here, and all of that investment time that you took actually spending researching it, and then the money that it took to buy the security is the opportunity cost. So that can be broken down to a bunch of different ways. You can say the time that you spent researching could have been spent in a different way. And that I just want to make sure that we nail home the idea of opportunity cost and like in that. Jen, you have anything to add? I kind of trailed off.
Maybe another way to think about this. It's like if you have $100, if you put it in your savings account, you earn, let's say, 2% interest, and you're missing out on the opportunity cost of investing maybe in a stock or something that you get a higher return. So the opportunity cost there is what you're missing out on, like Daniel said earlier, that it's either you do this or you do that. But if you pick option A, you're missing out on the opportunity cost of option B. So that may be I don't know, a more confusing or easier way to think about this.
Yeah, and that helped me a lot remember the example I was trying to say. So the opportunity cost, like Jen said, A over B, but you also, when you choose a more passive kind of idea that's less risky, you may lose out on more money, but you lose out on the risk. So what Jen was saying with his example about the 2% bank account with 100 and you could get 102, but you're missing out on option B. Option B could also be inherently more risky, but you could earn more. And I think that's what's going to trail us into the next kind of bit, where active versus passive. Yeah. So what is passive investing? It's an investment strategy that tracks a market-weighted index or portfolio. Passive management is the most common equity on the market, where index funds track a stock market index. It is becoming more common in other investment types, including bonds, commodities, and hedge funds. So passive investing, like we were saying, is the more conservative risk that you can take in the market. So again, we're going to give you some more definitions. Passive management is an investing strategy that tracks market weighted. Oh wait, no, that just repeated. Excuse me. Passive investing follows the idea that the market is bound to rise, and that you as an individual cannot outperform the market or professionals who do this full time. It's an interesting school of thought that people such as Benjamin Graham and Warren Buffett don't agree with, and they are on the other side of the paradigm, which is active investing. Oh wait, I thought there was gonna be another picture. This philosophy originates from the minds of the University of Chicago. I think they were in the 70s, and that class includes Jim Loery, Merton Miller, Scholes from Black Scholes model, and Jim Loery. And they're all incredibly well-respected Nobel laureate recipients, and they, as a group, butted heads against the active investing crowd. But above all, they both had the minds and the research to back it up. So there's no better, there's no worse. It's just purely opinion on what you believe you're going to subscribe to, whether it's the passive investing model or the active investing model. But here's the man who created the first index fund, Rex Sinquefield, another U Chicago grad. He co-founded the Dimensional Fund Advisors, which is a really cool investment mutual fund. So that's that. Yeah, so Sinquefield went to work at the American National Bank of Chicago, where he put these ideas into practice, developing in 1973 the first S&P 500 passively managed index fund. 7 years later, the fund managed $12 billion. Another fun fact about Rex Sinquefield is under his management, he created the first, with his team, created the first index fund managing REITs. So like, that's just a nerdy thing to get out there because I do love real estate. But that is the cool thing that his DFA fund created, was the first index fund managing REITs. So now you've heard me talk about passive investing. Let's think about active investing, because that's what we're going to be doing in this class. The idea that you as an investor can outperform the market. I subscribe to this idea. It's so much fun believing that you're smarter than everyone else in the market, and you can say that I have the research to back it up. Active management refers to a portfolio management strategy where the manager makes specific investments with the goal of outperforming an investment benchmark, index, or target return. So that's the purpose of financial statement analysis. That is the idea behind individuals making trades, buying and selling, trading on the difference in market value and underlying securities values. So those terms may have seemed a little bit foreign. It's easier if you think about it. Value investing and growth investing, if you've heard these terms, they're synonymous. active investing versus passive investing is value investing versus growth investing. I just wanted to make sure you guys know that, because I mix them up sometimes and they do mean the same thing. So we're kind of through what we wanted to talk about today in terms of coverage, and we would love it if we could just have a more candid chat. We saved a lot of time that we could just talk about the material, because the best way to learn it is by talking about it. So yeah, let's make sure. Yeah, so any questions about the material so far today? I'd love to talk more and just kind of go over that if anyone took notes.
Yeah. Are we going to be able to touch on other topics? Like you mentioned, real estate investing. I think that'd be really valuable for some of us. Like, could we do like little side things or side lessons about other terms of investing, even like investing in art, investing in like what it is to be like investing into companies, things like that, like investing into startups and things like that.
I do love those ideas, but I don't think that'll be covered in this course, because we're prepping for the stock pitch competition, and this is just investment fund. But no, if you, I talk with Chase probably a couple hours a week at least about just different types of investments. Like it's just,
okay.
That's just fun.
I'll come on that call.
I think that what you just mentioned is a good topic, because most investing you have to talk about it. So we might be able to talk about it through these Q&A sessions, because at the end of the day, investing is finding out the intrinsic value of a company or an asset. You want to know what the price of it is, the actual price versus, you have to know the value instead of price. It can be selling at, $150, but it's actually worth $100. So the main point of investing is you want to know what the actual value is instead of buying it at market price. So it's something that we can talk about through these Q&A sections.
So I think that's valuable. I don't know. I think we could just extrapolate on this question forever. So let's get it. I'm gonna go one more round and then we'll try to get another question. But that's all we're doing this series, is trying to understand value as an investor. And we're using the medium of securities, and that's what stocks are. So it's going to be a fun time, and we're gonna, like, that's why we broke it down in terms of opportunity costs, that's why it's not nitty gritty. It's supposed to be a lot more overview so that you understand the terms of what's happening in the market. So like, if you want to talk about real estate, that's why the structure of a REIT was created. I know that there's going to be, I think, 10 or 15 slides about why do REITs exist, a real estate investment trust. And it was created with the purpose of giving private investors an opportunity to participate in real estate. So that's going to be the securities way to talk about real estate. And in terms of art, I don't really know. I've never heard of it, but that'd be pretty cool if there was some way to monetize it into that. Thinking about it, it doesn't pop into my head, but there's definitely going to be, because everything's related to companies and markets. So there definitely is, just off the top of my head, a commercialized showroom that may or may not be publicly listed, and then whatever goes into that would be something to think about investing. And because we're not going to go deeply into like PE space stuff, that's kind of where we would stop. But if we would talk about how to invest in that endeavor and expand their market opportunity. And actually, I think consulting does a lot of that, except they stop at what we do. They just say, this is a good idea, here you go, and doesn't get into corporate and capital structure stuff. But in terms of the other types of investing, I know Chase and I spend a good amount of time talking about capital stacks and what does that mean to other industries. And across the board, once you take corporate finance at NYU Shanghai, there's not going to be anything new in terms of corporate structure, because everything in terms of debt and equity, enterprise value, equity value, all stays the same after you take that class. It doesn't matter what field you're in. It could be buying a sports team. You still have debt and equity. You still have enterprise equity value. You still use the same ratios. You could be buying real estate projects. You could be buying green energy assets. You could do anything and it would be the same structure. So we're going to get into that briefly, as an overview, but we're not going to deep dive into that because we have to talk about stocks because that's this course.
Thank you.
Steven, it looks like you have a question. I see a question in his face.
I'm
shaking.
good. I'm chilling. I'm good. I got nothing.
Steven, was there anything you didn't understand? I'd love to go back over it.
I mean, I gotta be completely honest. I missed like the first 20 minutes, so I probably missed something. But
Got it.
I will definitely go back and look at the slides if they're posted somewhere.
All right. Good man. Really, any questions? And then we'll move on to kind of what we want to have our conversation about. Justin looks like he's smiling. Justin? You're muted. Yeah.
Yeah, well, I don't know. It sounds silly, but would like
Nothing
hybrid
silly.
investing be like a valid strategy, like a mix of passive and active investing?
Oh yeah, that of course. That's the best. Yeah, of course. You want to have yeah, let's talk about that. That's how you're supposed to do it because you have different types of portfolios and that's what people do. I know in my own portfolio, I keep right now because I'm really scared. I have 50% in cash and then I probably only have 10-15% in like an active investment mindset where I believe like this is an undervalued stock and I'm going to get into it. The rest is all market stuff. So 100%. And like no question's a bad question. And that's great. And yeah, that's 100% right.
Hey Daniel, if I could chime in real quick with some like real world stuff. For those of you guys who haven't met me, I'm Harrison. I'm a senior, but right now I'm working for a fund as an equity research analyst, and this fund is like brand new, under a year old. But the way we have it set up is we have 3 separate sub funds that operate, and one is actively managed, one is done by the quant team, and then the third is a real estate fund. So you'll see that at a lot of funds will have this, where they have different sub portfolios managed in different ways.
That's awesome. What's it called? I'd love to look at the real estate fund.
It's called Encephalo, but the real estate fund hasn't actually done any transactions. It just got set up.
Got it. That's cool. That's awesome. But yeah, no, it's if you look at the structure of large funds and large investment teams, they all have different portfolios. And as a private investor, you can have different portfolios, but I just kind of I don't have enough money to have multiple portfolios. But that's how I manage it. Jin, I know you're really active. I know you have a couple of ETFs that you're passionate about. Jen, are you muted? I can't hear you.
Did you say Jer or Jen?
Jen.
Oh, sorry. What was the question?
I know you have a couple ETFs and things in your portfolio, kind of passive that you've been talking to me about for months now.
Oh yeah. The way I look at speculation and investing is that speculation is more that it's a game of supply and demand. So you're trading on the market emotions. So for example, President Trump got COVID. So how's the market's going to react? So it's the thing.
Oh, do you guys want to know something funny? Because we're being more candid. We're past the formal part of the lecture. At the beginning of COVID, every time Trump spoke on TV, the markets went down. So they started having him speak after the markets closed. That's a real thing that happened, and it was a decision someone made in the White House. And that's how the markets are affected in speculating markets.
Exactly.
And I just thought that was so amusing. And like, it wasn't in the news that it happened. I was just paying attention and I was like, what's going on here? And then I noticed it a week later. They moved his conferences back an hour and a half to make sure that it no longer affected the markets. It was something really kind of crazy. Jen, I'll let you hop back in. Sorry. My bad.
Yeah, it's basically catalyst. You're trading on the emotions of the market. So as investing, you're really holding that investment over the periods of 5 to 10 years. So if you, after doing analysis of the company and if there's future growth, you want to hold on to it regardless of what's going on in the market right now. So right now, I think I'm in the same boat as Daniel. I'm kind of scared. I don't know what's going to happen in this, presidential election and all this COVID stuff. So I actually got out of some of my positions to be more cash heavy instead of investing all of my money. So as of right now, so.
Yeah, if anyone has any ideas for what's going to happen for fourth quarter, I'd love to hear it, and we can all just chat about it. That's the thing, we're not in a classroom, so we can't have more candid discussions. But I'd love if someone kind of hopped in and said what they thought would happen in quarter four. There's no wrong answer. It hasn't happened yet, and it's your opinion. Chase?
I think the markets are going to crash after the election, personally.
After the election, so soon.
I think right now, like with our quarter projection, I think the last month, the market's just been amazing. Honestly, they've taken a few dips, but it's been pretty good. And I think a lot of people are going to be really, really unnerved and a little uneasy around the election time because both sides right now they don't really know what's going to go on with whoever wins. So I think regardless of the election, we'll see a dip. How big of the crash, I'm not sure, but that's what I think. But I think by the end of the quarter, we will be not on a negative track. We'll be going back up, but it depends on how much it crashes after, is what I think.
Any other thoughts?
I'm right with you. I'm with you there, Chase. I think what's really going to lead the recovery after the election volatility, I've been researching, and I think industrials and infrastructure stocks are going to benefit a lot because both parties are pro infrastructure, and that's a good way to recover from a recession. So, I'm buying lots of materials companies, industrial equipment manufacturers. That's how I think it's going to recover towards the end of the quarter.
What are you looking at, Scott?
Pretty much Caterpillar and Martin Marietta.
Yeah, that's it.
Martin Marietta they make
right,
asphalt for roads and stuff.
Look at John Deere too, because they still have the market share of their industrial equipment. That's not the word. Vehicles. Got it.
Okay. There you go.
Another thing that I think is going to happen, just because I want to make sure after the lectures we all just have a space to talk about stocks, wanting to do an information share and ask questions. So I'm going to speak as much until anyone else wants to speak, and then that'd be great. I think fourth quarter is going to be a really hard time for consumer goods, because if you look historically at the US fourth quarter, that's when the most consumer spending is. So think about a Procter and Gamble. Across the market, they have the conglomerate on consumer goods, but this is going to be a real time when Americans in the fourth quarter aren't buying shit. So it's Christmas. It's in America, it's super, I don't know, semi-religious, quasi-religious around Christmas and Hanukkah, about consumerism really taking over. And I think this might be the first market in a long time where we see that not happen, and just a reduction of it, even if it's 20 points, it's a huge dip compared to historically what it's been for fourth quarter. Any thoughts on that for anyone?
Do you think that would extend to online shopping, like Amazon? Do you think Amazon would be hurt by that?
So back to actually
brick and mortar.
What I think Ali said about the real estate, and then bringing into what Harrison was talking about in terms of the REIT portfolio, I think, we're going to talk about this in lecture 7, which is going to be a little far away, and we'll learn a lot more terms by then. But I think the industrial space as well as logistics space in real estate, which have already been booming before this with e-commerce becoming such a huge thing. But I think quarter 4, we're going to see REITs like Prologis explode. And like personally, I think Prologis is overvalued right now because it doesn't make sense that a REIT gains value this quickly. But I think in terms of speculation, like if I'm buying a stock in my speculation in my roughly 10% of my portfolio, I think I'm in Prologis, excuse me, as a logistics REIT. And I think that brick and mortar, what you're saying, in the REIT space, the real estate investment trust space, will actually go up quite a bit. So like there's still I think 75% of the REITs that you can still buy at discount. And I could talk about this for hours, the REIT market, but yeah, that's my answer. I think so.
Adding on to, sorry, go for it.
You're up.
Yeah, adding on to what you're saying, like I can just tell you from a more like microeconomic scale in Hong Kong, like people's disposable income, at least in the higher network areas, like if you were gonna travel this year at all, if you're gonna do like any big parties or things, like you don't have that. Let's say you put away $10,000 to like go on a vacation, do something. You're not doing that. So what I can see from Hong Kong's already a very like lavish place. The amount of yachts outside now have like full like tenfold. It's ridiculous now. Like it looks like Monaco every single day. And I think that's what's going to happen with Christmas as well. Maybe you're not able to go to Disney World this year because the NBA is there. So maybe at least, again, this isn't for all households. I'm saying maybe in the top 10% are households who have some sort of disposable income. And they're going to say, oh, maybe I'll get like a nicer computer this year because like I'm not going away. And like a computer is going to help more than like, I don't know, go to Hawaii, something like that. So I think that's going to be an interesting turn to see how like maybe it's going to be more of like a physical good for gifts around the holiday season, Thanksgiving, Hanukkah, Kwanzaa, all that stuff. And less of like, it's an experience. We're going to we're going here, we're going there. So I think that'll be kind of cool to see.
So to that end, when do you think airlines will pick up? How quickly after COVID do you think the airlines could pick up? That's out to everyone, but Ali has first dibs on answering that.
I think right away, once COVID's gone per se, like when we have a vaccine, I think the airline industry immediately is going to pick back up because so many people are just itching to get out. I know we all pretty much already are. Like, although I think people that do choose to save, like maybe not families so much in like the holiday season, but like single people, young adults, they're probably going to save up more for their splurge trip when they can finally go out again. So I think like once we have, so what?
Follow-up question. When do you think the stock price will rise, not just the industry? Because that happened 8 weeks ago.
Yeah.
And Jared and I were on top of that. Jared and I were calling and talking about it like a week before it spiked. We were like, it's time. And then I know I bought a whole bunch of American and United. I think Jared went in a little bit on Delta.
I think stock price will go up the next time we hear about vaccine progress because people will start planning their trips already, I think.
So open it back up to the group. What type of investing is that? If you're investing using news and understanding, like if this happens in the news, this price will shoot up because of what's the one word answer? I'd love if anyone answered.
Is it speculation?
It is. That's it. You did it. Yeah. So market speculation, it's a real thing. Like it happens. That's how Bitcoin prices rise and fall. It's not connected to anything. We can talk about any type. We can briefly touch and make comparisons to any asset class. I know cryptocurrency and Forex is something I do love reading about. I've never actually invested in, I've never pegged Forex, but I do like Bitcoin to get exposure to news media because that's what dictates Bitcoin. So like Bitcoin's all speculation. Like whenever we as people don't have faith in the government and US dollar, Bitcoin goes up. That's just how that's kind of been working as of recent. Bitcoin's so new that we don't have definite theories, but that's kind of the market consensus right now. And yeah. Anyone else have any interesting, cool things to say, or we can move on to the next kind of bit? So the recommended reading, this slide is probably going to stay the same all semester because each of these books are very chunky. So the book that I recommend above all, which I actually think Josh is reading right now, is Benjamin Graham's Intelligent Investor. And that is hands down agreed by all to be the best securities analysis book. You can go in without knowing anything and come out knowing a whole lot more. And if you already know a lot, you go out tuned up. So that's kind of one. Napoleon Hill's Think and Grow Rich, of course. Who this one's a little different. I gave it to Chase at the beginning of the summer. I've given it to a couple of my friends. It's called Who Moved My Cheese? And if you ever feel like going through kind of Chase, I'll let you take that over. Explain why.
It's more of a book, like if you're at a place right now where you're kind of like, what's next, and you're stressing out more about that, it's a really great read on how to like be excited about what's next and really be striving to look for new scary opportunities. Don't be afraid of something just because you don't know what is coming. Seek those things, seek being afraid, honestly. And that's how a successful person is built.
And before I to do all this work with me to make these slides, I gave him that book and then prefaced it.
Yes.
And then of course I ran a walk down Wall Street. Actually, I just got this today, Psychology of Money. It'll be a good read. It's a fun one. I hope. I've heard good things. But those are kind of the books. We'll have this slide on every lecture. And then we have a bit of kind of homework exercises that like we would love for you guys to do. And I think it's like, if you're truly serious about Smead Fund, you will do this regardless, because it just kind of reinforces what we were talking about today. And if you guys do the assignments, it's basically just reading. It's about being informed in the market. So basically you're just going to pick 3 stocks, one from each sector. So Scott was talking about industrials. So like you could get John Deere, you could get Caterpillar from industrials, you could get Tesla. I don't know, is Tesla technology or automotive? That's a bad example. You could get Ford from automotive, you could get IBM from technology. And just kind of pick 3 stocks, look at the price, just kind of read them. You're having an excuse to look at the market. And then in 2 to 3 sentences, really quick, write if you would invest in them, or like why, just why this stock. You could say, I like IBM because they're a very strong company and they have a monopoly over technology at this point in the market. You could say what Scott said. Scott did this already today. He said, I like Caterpillar because both people running for president's parties are backing up infrastructure. Perfect. That's a great idea. And like, as much as this is for you guys to practice, this is for us to learn all from each other. So hopefully you guys can get this stuff soon, and then I'll be able to work back in some of the results to the next PowerPoint and slide. And then finally, with one of those 3, read the securities annual report and investment prospectus. So that's going to be, it's 1 page of text, and it's going to be what I was talking about at the beginning about what it is and what the company stands for and what it does. And it'll just be summed up really nicely and really well in their SEC doc. So that's a good thing to start familiarizing yourself with as an investor and as you are trying to be more active in understanding the market. That's kind of it for us right now. Feedback, what do you guys want more or less of in the future? We're going to get more technical next week. I wanted to make sure this was a little bit more overviewed, and I hope you guys are excited. And if you're not, I'll try to change my tone to make it more exciting. Thanks, Steven. Steven's smiling. That's all that matters. As long as I can make Steven smile, I'm good. And Chase and Jim. If I can get one out of Jared, it'll be a success. Yeah, cool.
Just one.
Guys.
Sorry, Daniel. I'm gonna send a form to the chat. It's gonna help us just register attendance with NYU Shanghai. It takes like a minute to fill out. We just really need your school email. And if everyone can fill it out before they go, it'd really help us.